Welcome back to EDS, and in this video I'm going to show you how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year regardless of your account size. Even if you have a small account, I'm going to show you exactly what you need to do step by step. So the first thing is you need to navigate over to any equities underlying. We've got EWZ open at the moment. Any equity will do. All equities have the same option expiration dates. That's why it doesn't matter which one we choose. We're not interested in the underlying. We're not picking what we want to trade. We're picking the contract that we want to sell, how far out we want to be. Now, we want to be between 30 and 60 days out in time, and we also want to be on a monthly expiration date, not a weekly or quarterly. And the only expiration date that actually fits that criteria right now is February 21st, which is 52 days away. The next backdated month from there is 80 days. That's too far. And the closer month is January 17th, which is 17 days away, which is too soon. So February 21st, 52 days, that's where we want to be. We can take this information, come over to our watch list, and we can simply filter out any and all underlyings that have an earnings event in that 52 day range that we've just identified from our options contract expiration date. Now, the reason for this is because we don't want an earnings event to come along and increase volatility. The higher the volatility, the higher the options price, and we are selling these contracts, we are shorting these contracts, which means we are selling high, buying low. So we don't want to be in a situation where we've sold some contracts, volatility increases because of an upcoming earnings event or earnings announcement, and that then raises options price, because that won't be good for our P&L. So we want to avoid that, and we also want to filter out anything with a low liquidity rating level. The more liquid a market is, the tighter the spread is. The spread is simply the difference between the bid and ask price, and it's what you pay every time you get in and out of a position. So the tighter the spread, the less you pay, the more profit you keep, and we can make sure that we have a tight spread by filtering out anything with a low liquidity rating level. At this point, I simply it's a matter of personal preference, but I like to order everything from high to low IV rank. IV rank will tell us where implied volatility is in relation to itself on that specific underlying over the past year. So it's a very good indicator to use. We typically want to be selling underlyings with a high IV rank. High can be anything over 50, sometimes over 30 is fine. It just depends on what the market is currently doing. So we want to go down the list, and we want to see what would fit well inside of our portfolio. Make sure everything's nice and diverse. Make sure you're not too heavy in any given sector or any single sector or industry. We've got XLU here, which is currently trading at just over $76 a share with an IV rank of 50.5, which is quite nice. It is the utilities ETF. ETFs don't have company risk, so you can typically expect a smoother P&L curve. It has an absolute IV level of 16%. Let's take a look at XLU. Let's pull up the expiration dates for XLU, and we already know where we're going to go. February 21st, as we decided at the beginning of the video. And now we are presented with the options chain. And at this point, we simply want to do what we always do, is sell one call and one put. We have calls on the left, puts on the right. The horizontal orange bar shows us where the price of XLU currently is with respect to the strikes, and the vertical orange bar shows us what the expected move is of XLU over the next 52 days. Now, we want to sell one call, one put. Where are we going to sell them? Well, we want to sell them somewhere outside of the expected move, because remember, we are writing these contracts, which means we don't want price to go anywhere near our contracts. So how do we know? How can we use expected move to decide what strikes we're going to sell? Well, since we don't want price to go near our contracts, and we know what the expected move is, we can simply sell outside of the expected move. Now, the question is, how far outside of the expected move do you go, or how far out of the money do you go? Well, we have our standard deviation lines here, our dotted blue lines, and we kind of want to be around the one standard deviation mark. We can also use delta. We want to be around the 15 to 20 delta mark, and typically all three of these things, the one standard deviation mark, the 15 to 20 delta, and the expected move being just outside the expected move, all three of these things will typically line up pretty much every time. So if we just start with delta, we've got a 17 delta here on the call side, an 81 strike, and we've got a 19 delta on the put side at the 72 strike. And as you can see here, we're outside of the expected move. We're pretty much up against the one standard deviation level, and we are smack bang in the middle of being between 15 and 20 deltas. On the put side, we could even be slightly more conservative and go with the 15 delta instead of the 19 delta. This is just down to personal preference, and then we really are up against the one standard deviation move here. But we'll just leave it at as a conservative 15 deltas for now. And this is basically it. This is the position. We've created a range for ourselves between $71 and $81 a share, and what we want to happen here, we've just got filled on something. I've just missed that, but we just got filled on something. This is a live portfolio, by the way. So what we don't want to happen is we don't want price to move beyond $71 and $81. So we want price to stay within this range. Now, what is the likelihood of price staying within this range? It should be pretty high because we are outside of the expected move. How do we know exactly what our probabilities of success are here? Well, in the bottom left above our order, we have our POP, which is probability of profit, and this is the probability of making at least 1 penny on the position at expiration, and we've got a 75% chance of making at least 1 penny on this position. And if we don't want to wait all the way till expiration and we want to get out at say 50% of max profit, we've got an 85% chance of being able to do that. So we're looking at probabilities of success between 75 and 85%, which is very, very high. Now, how much money can we make off of this? Well, this number down here shows us basically what we would try and get filled at. This is our premium. This is 85 cents a share. There are 100 shares per contract, so you'd multiply that number out and we get a max profit of $85. Now this is what we would collect up front. Automatically our broker would add it to our cash balance, and our broker is going to require just over $1,000 in buying power to open this position. So we're looking at a little under 10% return on capital on this position, which isn't bad for a naked position and it being an ETF. Typically, if this was a individual company, would collect more premium, have a higher return on capital, but then we're also taking on company risk. It's important to balance out your portfolio with a mix of companies and ETFs. If you wanted to collect more premium, you simply could be more aggressive. Go to the 22 delta on the call side, go to the 19 delta on the put side. We are still outside of the expected move, but now we collect more premium up front. We're looking at collecting $115 as opposed to the 80 or 85, whatever it was. Now, $1,000, 1.1k, etc. It might be a little bit too much for some portfolios, especially at the beginning. I did say I'm going to show you how you can write contracts, even if you have a small portfolio. So this isn't really suitable for a small portfolio, depending on how small the portfolio is. So I'm going to show you now how to manipulate this position to make it fit inside any size portfolio. So we're going to keep the basis here. This is how we generate cash with our short strikes. And what we're going to do is we're going to use some of this premium to buy some contracts further out from our short contracts to basically cover our position. So let's just go say $2 wide. So we'll go to $82 here, and we'll buy the 82 strike. So we sell the 80, buy the 82. We do the same thing on the put side. We sell the 72 and we buy the 70. So we've created a $2 wide range or spread in between on either side, in between our short and long contracts. Now what this has done is it's defined our risk. So our risk is no longer unlimited. It's now defined by whatever the spread is, which is $2 minus the premium that we collect, which is 54 cents. You multiply that out by 100 because of the contract multiplier, and we get our max loss here of $146. Before it was unlimited, now it's $146. It's capped, and our broker knows what our max loss is, so it only needs to hold that much in buying power. So as you can see, we've reduced our buying power requirement from over $1,000 to $146. We do collect less premium up front, but that is simply because we've used some of the premium to pay for our long contracts. Now, if you notice on the left, our probabilities of success have dropped slightly. Now, this is because on the right, you'll see that we now have a much higher return on capital. We're no longer looking at below 10%. It's much higher. We're looking at a max profit of $54, and we're only looking to actually put up $146 in buying power to open this position. So the trade-off here is a much higher return on capital for a slightly lower probability of success. And this is how you can manipulate positions. So this is $146. You could go a little bit wider. Say you want to go $3 wide, collect more premium up front, require a little bit more in buying power. Just depends on the size of your portfolio. You can go $1 wide if you wanted to, collect even less premium up front, but require even less buying power. Now this only requires $70. And this is how you can find and manipulate positions to fit inside your portfolio. Now, there is also one other thing that you need to note, and that is the size of your positions. How much buying power are you allocating to each position? How do you know how much buying power to allocate to each position? Well, we've created a free position sizing template. The link is in the description. It's free for everyone to use. Just click this button here. It will take you to the spreadsheet, and the way it works is you enter in the size of your portfolio, and then you enter in whatever the current VIX level is, and everything below will then be automatically calculated for you. And all you need to do is use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power to allocate to any single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general. And as long as you follow this, you'll be absolutely fine over the long term. If you would like to learn in more detail about what we do and how we do it, again, link will be in the description. This time, click on EDS Premium. Get yourself signed up. Inside, you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It is a private community, so if you get stuck, you can speak with myself directly or with other like-minded individuals. There's a 100% money-back guarantee as well. So if after 6 months, once you've gone through the full course, followed some of our trades, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free on your part. Right now, it is £1 a month to join. The price will be increasing. However, once you're in, the price is locked in for you for life. It's so cheap at the moment because we've just launched, and the aim of EDS Premium is within 6 to 12 months to get you to a point where you are self-sufficient, you know what to do, you know how to write options contracts, you know how to generate consistent returns, and you don't need any external help or influence. You've learned the skill, no one can take it away from you, and we aim to get you to that level in 6 to 12 months. You're always welcome to stay and be a part of the community. However, 6 to 12 months is all you need, and after that you'll be good to go. So with that being said, I will see you guys on the inside.